Okay, let's unpack this. We are diving deep today into the Fairfax 2021 Shareholders Letter.
Yeah.
If you were looking for a real shortcut to understanding how one of the world's most successful insurance and investment firms thinks about capital, risk, value, well, this letter is pretty much required reading.
It really is. It's more than just a summary of the numbers, isn't it? It's like a statement of their whole philosophy.
Right.
Our goal today is basically to go beyond just the press release figures and pull out the core strategic stuff, the financial moves, from what they themselves called, well, the best year in our history.
And looking at the sheer scale of growth, it's kind of hard to argue with that statement, honestly.
Mm-hmm.
For you, the listener, here's the hook. The company reported that in 2021 alone, gross premiums written grew by, $4.8 billion.
That's right. A huge number.
Yeah, and to put that into perspective, the letter actually notes it took them the first, 18 years of their existence combined to hit that same annual premium volume.
Wow.
That's just explosive acceleration.
It really speaks to the power of, well, a hard insurance market coupled with some really exceptional underwriting discipline.
Right.
And that acceleration, it led to just phenomenal results. They earned a record $3.4 billion. But, the key metric for any long-term investor has got to be the book value per share.
Always.
And it increased by a staggering 34.2%. And crucially, that's after adjusting for the $10 per share dividend they paid out.
Right.
So book value ended the year at $631 per share. Just fantastic.
Those results are really built on two pillars, aren't they?
Yeah.
You've got the decentralized insurance empire on one side, and then the long-term value investing strategy on the other.
Exactly.
Let's start with the engine room, the insurance structure itself. Most big global firms today, they strive for massive, efficient centralization, chasing those cost synergies.
Yeah.
Fairfax, well, they deliberately avoid that.
They completely reject that model. It's pretty striking. The company runs as a fully decentralized federation, basically, operating with 23 highly empowered presidents and over 200 profit centers. And they specifically say they forego potential cost savings because they believe the benefit of having these really nimble entrepreneurial companies, companies that can respond instantly to market changes. Well, that far outweighs any savings from centralizing things like the back office.
But, in an age of AI and instant communication, is giving up potentially millions in cost synergies really worth it just for that local nimbleness? Doesn't that feel a bit old school?
Well, it's a calculated risk, absolutely. But you look at the 2021 results, and they kind of validate it, don't they? Nimble companies are just essential in a hard insurance market where rates are moving up and risk is changing fast. That decentralized structure lets them deploy capital and price risk way faster than, their slower, more bureaucratic competitors.
Okay.
And we see the proof right there in the consolidated combined ratio. It landed at 95%.
Okay, let's pause on that combined ratio, the CR. For listeners who might not deal with P&C insurance every day, why is a 95% CR so significant, especially in a year like 2021?
Right. So the combined ratio is really the ultimate measure of underwriting discipline. It's basically claims plus expenses divided by the premiums earned. Anything below 100% means they made an underwriting profit before you even think about investment income.
So it's pure profit from the insurance itself.
Exactly. So achieving 95% is fantastic on its own. But the context here is critical. The group absorbed $1.1 billion in catastrophe losses.
Right.
Yeah, things like Hurricane Ida, the European floods, those added 7.2 percentage points to that ratio.
So wait, they were already sitting at, like an 88% underlying profitability before those massive unavoidable shocks hit?
Pretty much, yeah.
That really underlines the structural quality of the portfolio then.
It does, absolutely. Almost all their major companies performed exceptionally well, landing below 100%. You had two domestic stars, Zenith and Northbridge. They won the internal combined ratio sweepstakes, coming in at 88% and 89% respectively.
Wow.
And then on the growth side, Odyssey Group had the most significant premium growth, expanding by 29%.
And who generated the highest pure underwriting profit number?
That was Allied World. They delivered $226 million in underwriting profit, and they grew their premiums by 25%.
That's impressive growth, too.
It is. And since Fairfax acquired them back in 2017, Allied World's premium volume has nearly doubled. It reached $5.8 billion in 2021. So this really demonstrates their strategy, right? Buy undervalued assets and then let excellent management grow them organically.
Okay. This strong underwriting performance brings us, I guess, naturally to the concept that kind of ties everything together,
Yeah.
the float. This
Yes.
is the financial bedrock of the whole operation,
That
isn't it? Tell us about the state of the float.
So the float is essentially the premiums they receive upfront before they have to pay out claims. It's money that just sits there in the bank, available for investment. It's a really unique structural competitive advantage.
Right.
And in 2021, the float grew substantially. It hit $27.8 billion. That translates to $11,166 of float backing every single share.
And this is where it gets really interesting, right? The cost of that capital. Most companies have to pay interest to borrow money, but this capital is just generated through their operations.
Precisely. And in 2021, because they made that $801 million underwriting profit, the cost of that huge $27.8 billion float was actually a benefit of 3.3%.
A benefit, not a cost.
A benefit, yeah. And over the last 10 years, the float has basically cost them nothing. It's provided an average 2.1% annual benefit.
So if you put that benefit against, say, the average 10-year Canada Treasury bond yield of 2.1%, which is almost risk-free, right? You get a 4.2% financing differential advantage. I mean, we're talking about raising almost $28 billion at what is effectively a negative interest rate.
Yeah.
Why is that specific advantage just impossible for, like, a normal bank or even a tech company to copy?
Well, it comes down to the regulatory structure for insurance. They are legally required to hold capital and maintain high liquidity precisely to pay future claims. A bank has to pay interest on its deposits, right? And a typical company issues debt, pays interest on that. Fairfax, just through disciplined underwriting, is essentially being paid to hold this massive pool of capital.
That's incredible.
It's a self-financing, self-reinforcing competitive moat. They earn investment income on the $27.8 billion, and they make a profit on the underlying insurance business. It's truly exceptional.
Okay, so now let's turn to how they actually deploy that massive low-cost capital engine. This takes us right into their investment philosophy, which is rooted really firmly in Ben Graham's value investing principles.
Yeah, they opened the investment section with a Graham quote, didn't they? Proclaiming that the renaissance of value has begun, but only just begun.
Right.
And this statement is really critical because it gives you the context for their cautious posture, even while the S&P 500 was just roaring ahead with a 29% return in 2021.
Yeah, seems counterintuitive.
Well, they're comfortable with what they call lumpy returns because they prioritize capital preservation and long-term intrinsic value over, chasing quarterly momentum.
Speaking of caution, let's look at their liquidity strategy, because this is where, maybe, the conversation gets a bit challenging for some. Given that massive market run-up in 2021, they chose to keep, 72% of their entire investment portfolio in cash equivalents, and short-term treasuries or fixed income.
Yeah, a huge chunk.
Did that massive cash drag, did it mean they missed a huge opportunity?
Well, that's the challenge a conservative investor always faces, isn't it? But management defends this. They see it as intentional optionality and risk mitigation.
Okay.
Their fixed income portfolio had a very short average duration, only 1.2 years, and a really high average rating of AA. This just signals extreme caution about rising interest rates and inflation.
So holding that cash wasn't really about being scared. It was more about positioning for what they saw as an inevitable market adjustment and rising rates.
Exactly. And they were pretty smart about timing their retreats, too. Remember, they sold $5.2 billion in corporate bonds. Bonds they had wisely bought back during the market panic in March and April 2020.
Ah, right. Classic move.
Yeah, that sale netted them a gain of $253 million. That's the classic value investor play. Deploy capital when everyone else is panicking, take profits when the market gets frothy, and then retreat to high-quality, short-duration assets when risk seems high again.
Okay, shifting to their common stock portfolio. The accounting here can be notoriously opaque for outsiders, right? We see holdings split into three buckets: mark-to-market, equity accounted, and consolidated.
Yeah.
How can we make sense of this sort of complex structure for the listener?
Yeah, the complex accounting really just reflects how much control or influence they have over the company they've invested in.
Okay.
The main takeaway, I think, is that management is constantly looking for value that the market just hasn't priced in yet. They use these different methods just to report their ownership fairly. And the portfolio itself, it's filled with industrial and cyclical value plays, not flashy tech.
Can you give us an example of a holding that really exemplifies that value realization in 2021?
Stelco is a perfect example. It's a deep value industrial holding, right? Its price changed by 81% in 2021 alone. And Fairfax increased their ownership stake to nearly 18%. Another great one is Atlas, which is mainly C-SPAN, the biggest independent container ship lessor in the world.
All right.
They note in the letter that C-SPAN is expected to grow its fleet substantially by 2024, which indicates just massive locked-in revenue for years ahead. Again, these are not trendy tech stocks. They are hard asset, cash-generating businesses.
And overall, the market is still undervaluing these types of assets, correct?
Yeah.
According to them.
That's certainly management's view. At the end of 2021, the overall market value of their common stock holdings actually exceeded the carrying book value by $346 million.
Okay.
So that indicates that even after a great year for some of them, there's still, unrealized value embedded in their equity holdings, basically waiting for the market to catch up.
Let's move across the globe now to a major geographical focus for them, India. The letter talks about India with just tremendous enthusiasm. What's driving this focus?
The conviction is really profound. They state their belief flat out that India is the single biggest opportunity for investors in the next decade.
Bold statement.
It is. But it isn't just speculative hope. It's based on seeing macro transformation and a massive commitment to infrastructure happening on the ground.
They cite specific policy changes by Prime Minister Modi, too, suggesting that governance stability is, key to their investment thesis there.
Absolutely. They focus on tangible progress. Things like the ambitious Jal Jeevan mission, which aims to bring clean tap water to 192 million rural households.
Incredible scale.
Yeah, and by the end of 2021, they noted over 92 million of those households had secured a tap water supply. They also highlighted the creation of the new infrastructure bank, this kind of commitment to domestic foundational improvement. Well, it lowers a risk profile for private investment, doesn't it?
Yeah, makes sense. Tell us about the success stories they are seeing within that Indian portfolio.
Yeah.
The growth numbers for some of these assets seem almost contradictory to their conservative value investing reputation elsewhere.
Yeah, it's interesting, but they reconcile that contradiction by focusing on finding deep fundamental value, even in these high-growth markets. Take Digit, for example. Okay.
It was the first Indian unicorn of 2021, valued at $3.5 billion. And here's the key difference from so many global unicorns. It's already profitable.
Profitable unicorn, rare breed.
Exactly. And Fairfax's investment in Digit has generated an incredible compound annualized return of 114.2% since 2017. That is just a massive home run.
Wow, 114% compounded annually. That really shows the power of marrying a high-growth market with management discipline.
It really does. And on the infrastructure side, you have Bangalore International Airport, or BIL. They call it their definitive crown jewel.
Right.
It makes up over 1/3 of the fair value of Fairfax India's total investments. And given the reference to the new infrastructure bank, it's pretty clear BIL is perfectly positioned to benefit from huge public and private investment in aviation and logistics going forward. They're even planning to take BIL's holding company, Anchorage, public eventually.
And we also saw success in the financial sector there too, right?
Yes. CSB Bank had its best year ever in 2021. Net income was up 63%, and they achieved an industry-leading net interest margin, or NIM, of 5.3%.
Right.
Very strong.
And they keep adding to the portfolio. Recently, they acquired stakes in a precision aluminum die-casting firm called Maxop Engineering and a non-ferrous components manufacturer, Janix Engineering, strategically targeting growth opportunities in North American and European supply chains.
Okay, so this brings us back to the broader market and management's view of the future. The letter was published just as that massive tech correction started in early 2022, wasn't it? They clearly saw that rotation coming.
Oh, they were definitely sounding the alarm. They specifically documented the dramatic volatility hitting those high valuation tech stocks right at the start of the new year. They highlighted that Netflix was down 35%, Shopify was down 50% from their year-end peaks.
Right.
This just reinforced the idea that, yeah, they were right to be cautious and right to keep 72% of their portfolio highly liquid.
The ultimate illustration of their thesis, I thought, was in the comparative valuation they provided. Contrasting high-flying tech with their own industrial holdings, it really grounds that abstract idea of market irrationality.
It's probably the most entertaining part of the letter, actually.
Yeah.
They contrasted Zoom, kind of the poster child of the 2020-2021 bubble, right?
Right.
Which had a $40 billion market cap, generating $4.1 billion in revenue and $1.4 billion in profit. Then they compared it against their holding Stelco.
The steel company.
Right. Stelco had the same revenue, $4.1 billion, actually a higher profit at $1.6 billion. But its market cap was only $2.7 billion.
So hold on. The market was valuing $1.6 billion in profit from a physical asset company at $2.7 billion
Hmm.
and $1.4 billion in profit from a software company at $40 billion.
Exactly.
That gap is just staggering. And it really underscores that just begun nature of the value renaissance they talked about.
It completely justifies their patient approach and their massive liquidity position, doesn't it?
Yeah.
They were basically waiting for this huge arbitrage opportunity to start closing, and they knew inflation was probably the trigger.
And what major macro risks did they specifically call out that justified this conservative stance?
Well, inflation and the Fed's response were number one. They noted the CPI hitting 7.5% in January 2022, a 40-year high, and they expressed direct concern that the Federal Reserve was behind the curve in raising rates.
Okay.
They explicitly warned that higher interest rates would basically destroy the speculation driving those high-tech and crypto valuations. They also continued to flag the precarious risk tied to the China real estate bubble.
So their strategy, short duration debt, massive cash reserves, value stocks. It was like a playbook designed for exactly the inflationary high rate environment that they predicted was coming.
Absolutely. And when the macro environment gets this volatile and unpredictable, the reliance shifts, right? It shifts away from market momentum back to intrinsic business quality and maybe most importantly, management quality.
Right.
That's why they closed their commentary, quoting the legendary investor Phil Carrot. Good management is rare at best, and it is undoubtedly the single most important factor in security analysis. They're relying on those 23 decentralized presidents to navigate whatever storm comes next.
This has been a really fascinating deep dive to kind of synthesize everything for you, the listener. 2021 proved that Fairfax's unique model really works under pressure. Success seems to rest on two non-negotiable pillars: that surgical underwriting discipline, proven by the low combined ratio, and patient, long-term, value-driven investing backed up by a war chest of liquid assets.
Yeah, that combination ensures they profit both from a hard insurance market generating that massive premium growth and from market dislocations where they can deploy capital cheaply and effectively when others can't. It's really a beautifully constructed kind of defensive financial moat.
And the ultimate competitive advantage, the concept that truly separates them from almost every other company out there, is that float. It's the engine that just never stalls, it seems.
Indeed. Just think of that $27.8 billion of float, which translates to over $11,166 per share of capital. This capital, which, as you said, is described in the letter as generating a benefit like negative interest rates, well, that's the structural secret. It allows them to earn money on their assets without actually incurring a financing cost. So for you, the unframed investor listening, the question to really consider is this. In a world where capital is expensive and competitive advantages often seem fleeting, how many companies do you know that can fund their growth with billions of dollars that they are effectively being paid to hold?
Yeah, many, I guess.
Very few.
Yeah.
That cost-free advantage, that's the real power of disciplined insurance.